Hello and welcome back to the next video in our Investing Fundamentals course. And in this one, we're going to talk about EBITDA or EBITDA. You can pronounce it the way you want. I've heard it multiple ways, really. But what is EBITDA? So I do have a notes tab here that you can quickly take a look at in order to see what it means. So EBITDA is earnings before interest, taxes, depreciation, and amortization. So you can see EBITDA. That's where it comes from. So earnings before interest, taxes, depreciation, and amortization. What does that mean? So normally the earnings a company makes, and you have watched my previous video when I was talking about the net earnings basically of a company, is normally everything the company makes in terms of money that excludes interest, taxes, depreciation, amortization, expenses for cost of goods, everything. So basically, if you exclude all the expenses that the company has, net earnings is what the company gets to keep for themselves after all the expenses. Now, Wall Street kind of created an accounting term which is called EBITDA, which refers to earnings if you exclude these interest, taxes, depreciation, amortization expenses. And the point behind that is they wanted a way to measure the earnings of the company and compare it to other companies if you exclude potential debt that the company has and interest that they are paying on that debt and depreciation that they may have for some assets or amortization for some intangibles. So they created this as a way to actually compare companies based on their earnings alone, and they don't include these kinds of expenses. Now, Warren Buffett and Charlie Munger hate EBITDA, whatever you want to pronounce it again, and I agree with them. It's a fancy way of writing off, like logistically writing off important expenses, because amortization and depreciation expenses can be extremely important and they are hard expenses. And I'm giving, and it's not a coincidence that I'm using Netflix here. There's a reason for that. And what is the reason? So let's take a look at the income and EBITDA of Netflix. So if we go at the income statement here, if we take a look at the income statement, you will notice that their net income is $5 billion here, and that basically excludes all the expenses. But if you go down and take a look at the EBITDA here, you will see it's almost 7 billion. That's a massive difference. So why is that? And the main reason for that is the depreciation and amortization, in this case expenses. So what are those? Now, when Netflix creates a new series or a new movie, they have some expenses for actually making that movie. It's like they need to pay for the cast, they need to pay for the equipment, for everything basically to develop the movie. And all these are expenses, but the way it works with movies and entertainment material is these kinds of expenses tend to be amortized in a period of years. Usually it's 4 years. So that means that if Netflix pays, let's say, $10 million today in order to make a movie, this expense will be amortized in their financial statements in 4 years. So year one it could be 2.5 million, and then year four another 2.5 million, so that in 4 years you get to amortize all the expense of the $10 million, and that would be sort of like a linear amortization. And you may be wondering what's the difference between depreciation and amortization. It's basically the same concept. The only real difference is that depreciation is mostly about tangible stuff. Like, for example, a car depreciates in value, as you can understand. And you can depreciate that car in 4 years. So if a company buys a car for $50,000, they could have it depreciate over a period of 4 years where it's considered usable. And then it's given for scrap, for example. So you would see that in the financial statements as an expense, being depreciated every year. Now, a movie, however, or a license for a movie, it's intangible and it can be amortized instead of depreciated. It's mainly a linguistic thing, really, to tell you the truth. And it shows in a different manner in financial statements, like in the income statement. but it's about the same thing really. It's about assets depreciating. That's what it measures here. And so EBITDA is again a measure of a company's earnings without including these expenses. And I myself personally don't really take much of an interest in EBITDA, because I do count these expenses from depreciation and amortization as hard expenses, because they are. And I don't really care what kind of expenses a company has as long as they're expenses. However, I wanted to make this video so that you can understand what the concept and what the idea behind EBITDA is. And maybe you want to use it in your calculations, especially when you're examining companies that don't have high depreciation and amortization expenses. Maybe that's something that you want to take a look at. But overall, it's probably a concept that I wouldn't bother myself with using and analyzing too much, because again, I don't think there has a lot of merit personally. But still, I wanted to include it in a separate video so that you understand what it is about, in case you hear it, and you will definitely hear about it at some point for sure. So yeah, that was about EBITDA. And next up, we're gonna be discussing even more financial metrics. At some point, we're gonna get to ratios as well, like the current ratio and more, price to book and all that. So keep watching and subscribe, and I'll see you in the next video. Bye bye.